Hello everyone, and welcome back to Dr. Tao's Quant Lab. At the end of our last lecture, I mentioned that today we would be looking under the hood of order flow using cumulative volume delta, or CVD. However, true tick-by-tick CVD often requires you to purchase expensive third-party chatting software. As a quantitative educator, my goal is to give you a professional edge without forcing you to pay for unnecessary subscriptions. So today, instead of using third-party CVD, I'm going to teach you how to track institutional order flow using a free built-in alternative that is actually much better for macro swing trading, capital flow. Let's look at the capital flow panel in the app. You can see right here. Advanced brokers use proprietary algorithms to dissect every single trade on the tape and categorize it by size. You can see four main categories: extra large, large, medium, and small. The extra large XL and large or L orders are massive block trades. This is Citadel, BlackRock, and algorithmic dark pools. This is the smart money. The small orders represent the retail public. This is the noise. As quantitative traders, we completely ignore the small orders. We only care about the net flow of the extra large and large tiers. Is the small money aggressively buying, or we say inflow, or are they aggressively selling, or outflow? Now let's get back to the lecture. The most powerful way to use this data is by hunting for divergence. Markets are frequently engineered to trick retail traders into buying at the exact moment institutions want to sell. Look at this exact data panel on my screen. The overall net inflow at the top screen, it says plus $19.84 million. Retail traders see this green number, assume the stock is bullish, and aggressively buy. You can see it right here at the bottom. The small orders show massive inflow compared to outflow. But look at the top line, the extra large orders. They are red. They are in a state of net outflow. What is the mathematical happening here? The institutions are using the retail buying frenzy as exit liquidity. They are quietly distributing their massive positions onto the retail public at a premium price. If you buy blindly because the total number is green, you are the exit liquidity. Okay, so how do we use this lie detector during our afternoon golden window? When we spot a perfect pullback to the 5-day RVWAP or a dense cluster of green chips, we are looking to enter a swing trade. But before we execute, we check the capital flow panel. If we see that extra large orders have been printing heavily net outflow all week, we vital the trade. The smart money is abandoning the stock. But if we check the flow and see heavy extra large inflow, we have our institutional cosign. The big money is actively defending the zoo, and our golden window entry is validated. Now, before you go out and start blindly trading based on this panel, I have to give you a strict quantitative warning. Institutions know that retail traders look at these green and red numbers, and they will deliberately trick you. First, a massive spike in green extra large inflow does not always mean institutions are bullish. It could simply be short covering. If a hedge fund shorted a stock and wants to take profits, they have to buy shares to close the trade. That registers as massive inflow. But the stock is still in a macro downtrend. Second, institutions use options. They might aggressively buy millions of shares of stock purely to hedge a massive bearish options position. The tape looks bullish, but their actual math is bearish. And finally, we have algorithmic splitting or Iceberg orders. If an institution wants to buy 1 million shares, they don't hit the buy button once. They split it into 100,000 tiny 10-share orders. The system logs it as small retail inflow, when in reality, it is a giant whale quietly absorbing the market. This is why we never take a trade based purely on capital flow. And it is a secondary lie detector. Your primary signals must always come from the structural geometry of the chart. Okay, we have now mastered volume, VWAP, chip distribution, and institutional capital flow. You now have a complete multidimensional view of how the smart money operates. In our final lecture of this tier, we are going to look at the rarest, most violent form of institutional urgency on a stock chart, price gaps. See you in the quant lab.